For week 4, we are going to cover the statement of cash flows. Now, you may have covered the statement of cash flows briefly in Intermediate Accounting 1 or Accounting 310, but this week we're going to do a deeper dive and actually look at how you make a statement of cash flows. So our key topics for week 4 are to discuss the statement of cash flows, to look at its purpose and usefulness, to talk about the various components of the cash flow statement, and then we're going to look at how you create a cash flow statement and the individual components within that cash flow statement, including the operating section, the investing section, and finally the financing section. And then our second topic for this week is full disclosure and financial reporting. And this is going to look at financial statement footnotes and what footnotes are required. We're going to look at how companies determine their operating segments, and then we'll also look at other reporting considerations. So, the purpose of the statement of cash flows is really to provide information about a company's cash receipts and cash payments. It is organized into 3 sections: operating, investing, and financing. And what's really key about the statement of cash flows is that it basically takes accrual basis accounting, which we know is what's used to create our income statement as well as our balance sheet, and it summarizes accrual basis accounting into cash basis on the statement of cash flows. There's a component of the statement of cash flows that also includes a reconciliation from our beginning to our ending cash balances, and ultimately, and this is the case with several other of the financial statements, its overall purpose is to provide information about the timing, amounts, and uncertainty of future cash flows. So how is the statement of cash flows useful to its users, whether those users be investors or creditors or customers or even the company's own employees? And so first of all, it shows a company's ability to generate future cash flows. And how it does this is by showing the relationship between sales revenue on the income statement and net cash flows from operating activities, or net cash flows from operating activities and changes in cash. So what we really mean by this is the company had X amount of dollars in sales, but how well was it able to generate that sales revenue into actual cash from operations? It also shows a company's ability to pay dividends and meet obligations. And what this really gets to is where is cash being generated, hopefully from cash flows from operating activities, and then how is that cash being used? Is it being used to invest in plant, property, and equipment? Or if cash flows from operating activities are not sufficient, how are we financing our company? Through debt or through equity? The statement of cash flows also shows the difference between net income and net cash flows from operating activities. And this kind of gets back to point number 1, where we want to really see, just because a company had a lot of sales revenue, right, were they actually able to generate that into cash? And how this comes into play especially is because we know that in accrual basis accounting, there are a number of estimates that have to be made. Right? You estimate your bad debts, you estimate your depreciation, or you use some type of methodology. Now, when it comes to cash, though, right, there is no estimation. You either have the cash or you don't. So in some respects, people think that the statement of cash flows really is a more accurate picture of the financial health of the company. And then finally, the statement of cash flows explains cash as well as non-cash investing and financing transactions during the period. How was excess cash invested, or if operational cash flows were not sufficient, how was additional cash flow financed? Additionally, if you have material non-cash items, obviously non-cash items don't show up on the statement of cash flows, but you are required to disclose material non-cash items in your financial statements. So the classification then of cash flows. So the cash flow statement is broken up into 3 separate sections. The first is your operating activities, and that primarily relates to the cash effects of transactions that have entered into the determination of net income. Primarily what we're looking at here are cash receipts from the sale of goods and services, cash payments to suppliers and employers, and this is usually going to be made up of your current asset and your current liability accounts from your balance sheet. Investing activities tend to be long-term assets, such as making and collecting loans, acquiring and disposing of investments, and other long-lived assets. So again, from the balance sheet, these tend to be your long-term asset accounts. And then finally, we have financing activities. The financing activities tend to be your long-term liability and your stockholders' equity items from the balance sheet. And financing activities are activities such as obtaining cash from creditors, repaying the amounts borrowed, obtaining capital from owners, providing owners with a return on capital invested, and returning owners' investments. There are a few exceptions, and that is that investment income, whether that be dividends or interest that you earn because you've invested in another company, and interest expense are operating activities. Even though they are derived from investing or financing activities, because they are included in the determination of net income, they are put into the operating activities section. So, a typical cash flow stream over the business cycle. So we know that businesses go through a life cycle. And that life cycle is depicted at the bottom of the chart. They have an introductory phase where they're just getting started. Then they go through a growth phase. Then finally they enter maturity. Now they could stay in maturity, for a very long time and, potentially never enter decline. Or some companies then enter decline and ultimately have their demise, either because they get acquired by another company or they go bankrupt, etc. So then what we have on the other axis is the cash flows, and whether the cash flows are negative, meaning outflows, or whether the cash flows are positive, meaning that we have inflows. So what you'll notice in the middle then is each of the specific subcategories within this statement of cash flows. So let's start with operating. So usually, at the beginning of a company's life cycle, they tend to not earn any income. They usually tend to have a loss, and they usually tend to have negative operating cash flows. Now, as the company grows and matures, those operating cash flows tend to turn more positive. And so that's what's depicted with the orange line. Now, when it comes to investing, a lot of times when a company first starts, right, they need to spend a lot of money investing in buildings, plant, property, and equipment, and therefore they are spending a lot of money on investing activities. Therefore, they have significant cash outflows. That tends to level off through the maturity stage, and now it's possible then with the decline that they actually then would maybe start selling some of their assets, and therefore that would actually generate some positive cash flows. And then finally we have financing. Now the financing activities, when a company first starts, they need a lot of financing, right? They need a lot of cash because they're not making cash from their operating activities to help pay their suppliers, pay their employees, get their buildings off the ground. And so they tend to have very high positive cash flows from financing activities, whether that be through debt or through equity financing. Now, as the company grows and matures and cash flows from operating activities become positive, the company needs less and less financing through that portion of their life cycle, and therefore it tends to level off and even sometimes goes negative because now they're paying back some of their debtors or creditors. So this next slide really it goes through some companies in kind of the life cycle that they're in. So introductory phase, Tesla, they've been around for a number of years now, but they're really still just sort of getting their feet wet and creating themselves within the greater economy. Growth phase, Amazon, right? Just a few years ago, we would have probably said Amazon was in the introductory phase, but now it's kind of stabilized itself. It has, established itself, and now it's just looking for ways to grow. Maturity phase, Hormel Foods, right? They've been around for a number of years. They've got a solid product offering. They're just kind of, going along full steam ahead. And then decline phase is JCPenney, and I believe JCPenney is going bankrupt. So they're really struggling to, stay afloat, and so we're, likely to see their demise. So now we're going to move into how you prepare a statement of cash flows. So unlike some of the other financial statements, which are prepared from an adjusted trial balance, when you prepare a statement of cash flows, you need additional information. And the information that is required is a comparative balance sheet. And keep in mind that a comparative balance sheet is a balance sheet that shows 2 years worth of activity. And we need a balance sheet that shows 2 years of activity because what we're really focusing on is the change in balance sheet activity since the prior year. We will need a current year income statement, and we will also need selected transaction data. And that selected transaction data is really going to help us to determine whether some of the changes in the balance sheet activity were because of cash transactions or non-cash transactions. So then the basic steps to complete your statement of cash flows are first, to determine what your change in cash was. Second, to determine the change in net cash flow from operating activities. And with that, you can use either the direct or the indirect method. Thirdly, we are going to determine the net cash flows from investing and financing activities. And then finally, once we have determined the change in cash, the cash flow from operating activities, the cash flow from investing activities, and the cash flow from financing activities, we are going to reconcile that between the beginning and ending cash balances. Okay, so first of all, determining the change in cash. So we know that cash is included on the balance sheet, and so all we're going to do is compare the prior year ending balance to the current year ending balance. And if we look at the example presented below, we can see that cash went up by $7,000. So our change in cash for 2014 is $7,000. That also means that our net cash flows from operating activities plus our net cash flows from investing activities plus our net cash flows from financing activities, when added together, need to equal $7,000. Okay, step 2 now is to determine our net cash flow from operating activities. So, as I mentioned earlier, we are basically restating our revenues and expenses from an accrual basis accounting to a cash basis by eliminating the effects of income statement transactions that do not result in an increase or decrease in cash. So what we're basically needing to adjust for are non-cash items. The easiest, most straightforward example to think about is depreciation expense. Okay, so if you think about it, we buy an asset. When we buy that asset, okay, we have a debit to plant, property, and equipment, and a credit to cash. Okay, that right there is a cash outflow. Okay, we capitalize that asset, right, on our balance sheet and then depreciate it over time. And by depreciating it over time, we are debiting depreciation expense and we are crediting accumulated depreciation. Depreciation expense, right, is a component that goes into figuring out net income. So what that means then is our net income ends up being lower than it otherwise would have been had we not recorded any depreciation expense. However, we know that when we recorded that entry for depreciation expense, right, there was no outlay of cash. Therefore, on a cash basis, right, our net income is lower than it otherwise would have been. Therefore, depreciation expense gets added back to determine cash flows from operating activities because it's a non-cash item. There are two ways to determine cash flow from operating activities. The first is the direct method, which is sometimes called the income statement method, and that reports cash receipts and cash disbursements from operating activities. The second method is the indirect method, which is called the reconciliation method, and that starts with net income and converts it to net cash flows from operating activities by looking at all of the various balance sheet line items that are a component. Now, most companies will use the indirect method. However, companies can make an election in terms of which method they would like to use. So, the FASB encourages the use of the direct method because it is more transparent. However, if you do use the direct method, you are required to provide a reconciliation to the indirect method. As a result, then most companies use the indirect method because otherwise they would literally have to be doing the method twice. Now you might be asking yourself, well, why might some companies elect to use the direct method if they already have to show it using the indirect method? And each company is a little bit different, but generally speaking, right, because the direct method is more transparent, it means that it's easier for the investing community, for creditors, to understand your cash flows, and therefore, some companies find it beneficial to provide that more transparent information to make it easier for them, to get loans or, to enter into financing arrangements, etc. Now, if you use the indirect method, these are the types of adjustments that you are going to see. So we already talked about depreciation expense. That's an addition, an add back. Amortization of intangible assets works the exact same way. Other items that we have here are loss on the sale of plant assets, decrease in receivables or inventory, increase in AP or accrued liabilities. So what I would recommend is starring this slide so that you can come back to it as you're working on your problems. Okay, so here is an example of CVS, and CVS actually does use the direct method. And so what you'll see here is they classify their cash flows from operating activities in significant categories. So cash receipts from customers, cash paid for inventory, cash paid to other suppliers and employees, interest paid, income taxes paid, etc. So it's very clear kind of the categories that they are showing in terms of their cash flows. Now here at the bottom then is their reconciliation to or using the indirect method. And so what you'll see here is they start with net income and then they make adjustments. So for depreciation and amortization, goodwill, stock-based compensation, other non-cash items, and then you get down to the bottom and it's the changes in operating assets and liabilities. And this is where this information isn't necessarily very helpful, right? Accounts receivable, inventories, other assets, other liabilities, like that's not very descriptive. Now, what I also want to point out because students often get this wrong. So when we talk about the income statement and we talk about the balance sheet, we talk about the balances increasing or decreasing over time. Okay? When it comes to the statement of cash flows, these numbers presented here are not balances. Okay? What we're saying here is that accounts receivable had $1.139 billion of cash outflows. What this means then is that the balance of accounts receivable, the balance sheet balance of accounts receivable actually increased from 2017 to 2018. Okay, the balance increased. Because the balance increased on the balance sheet, the cash flow impact was more outflows. So when you talk about the statement of cash flows, it's very important that you talk in terms of inflows and outflows. Okay, so now let's actually take a look at how we calculate the components of net cash flows from operating activities if we were to use the direct method. Okay, so under the direct method, we're only going to show our major classes of cash receipts and cash payments. So cash receipts from customers, we're going to start with our sales revenue from our income statement, and then we're either going to add if there was a decrease in accounts receivable, or subtract if there was an increase in accounts receivable. So not both, but one or the other, depending on the direction of your balance sheet. For cash payments to suppliers, we're going to start with cost of goods sold. We're going to add an increase in inventory if the balance sheet showed an increase in inventory, or subtract a decrease in inventory. And we're going to add a decrease in accounts payable or subtract an increase in accounts payable. Now, for our class, we're simplifying this. This is assuming essentially that all changes in accounts payable are related to buying goods for resale, which is why we're putting it into the cash payments to suppliers. Right? It's possible that some of the activity that's in AP is for other purposes, but for our class, we're just going to assume it all relates to buying supplies and goods from suppliers. Cash payments for operating expenses. We're going to start with operating expenses from the income statement. We're going to add to it any increase in prepaid expenses, or subtract out decreases in prepaid expenses, and add any decrease in accrued expenses, or subtract out any increase in accrued expenses. And then finally, cash payments for income taxes. We're going to start with the income tax expense amount on the P&L, add in any decrease in income taxes payable, or subtract any increase in income taxes payable. Okay, so I already kind of went through this. You saw this example with CVS. But the direct method requires you to show, at a minimum, these following categories. I've kind of already talked about why some people favor the direct method, so I'm going to skip this slide. Okay, so now what we're going to do is we're going to go through an example. So here are the facts. So you'll notice we have here a comparative balance sheet. And then at the bottom we have some other notes. While they don't give us an income statement, the notes tell us enough information for us to be able to complete our statement of cash flows. Okay, so the first step then, so step one is already completed, we already determined the change in cash, was to really look at what the changes are in some of the other balance sheet accounts. So what my recommendation is to take the balance sheet, and to first show the change year over year. And then my recommendation is to specify which section of the cash flow statement you think that the item is going to go into. So, if you recall earlier, I said that usually, or generally speaking, current assets and current liabilities relate to operating section activities. Long-term assets tend to be investing, and long-term liability and equity accounts tend to be financing. So, we've already talked about cash. Cash doesn't go within any particular section. It's reconciled at the bottom of the statement of cash flows. So for right now, we're going to assume that other current assets are operating, long-term assets and plant assets are investing, accumulated depreciation. We're going to assume that it is operating if the change relates to depreciation, or it could be investing if it relates from the sale of an asset. Current liabilities are operating, bonds payable, common stock are financing, and then retained earnings is a little tricky. So if the change in retained earnings is because of net income, that's an operating activity. If it's actually a decrease because of dividend payments, that would be a financing activity. So what we're going to focus on right now are the lines that I highlighted in yellow, because I believe that those are the lines that may be related to operating activities. Okay, I mentioned that there are some additional notes, so this information is going to be helpful for us because it's going to help us distinguish or determine why some of the balances changed and whether or not there were any non-cash items that we need to consider. Okay, so let's first take a look at note 1. So note 1 says, in 2014, the company sold for $34,000, so that's how much cash they received, available for sale investments carried at a cost of $43,000 on December 31st of 2014. Okay? Actually, we're going to skip that one for a minute, sorry, and let's actually move on to first talk about retained earnings. So, as I mentioned earlier here, and if we think about how we start our statement of cash flows, we start our statement of cash flows if we're using the indirect method with net income. So first and foremost, we need to determine what net income is. Okay? So they tell us in additional note 3 that net income as reported on the income statement was $46,000. Okay, so if we go back and we also look at the retained earnings balance, it started at $20,000 and we got to $56,000 by the end of the year. So when we consider retained earnings, we need to remember that if we take our beginning retained earnings balance plus our net income minus our dividends, that's going to give us our ending retained earnings balance. Okay, so we started with $20,000. We had $46,000 worth of net income, which would give us a balance of $66,000. However, we know that the ending balance on the balance sheet was only $56,000. Therefore, that must mean that we had dividends of $10,000 during the year. It also says here in additional note 4 that the company paid dividends of $10,000 during the year. So, therefore, we've been able to reconcile our retained earnings balance. Okay, now let's look at what's going on with fixed assets. Now, when we talk about fixed assets, we're going to look at fixed assets and accumulated depreciation together because we know that they are interrelated. So first let's read what the additional notes tell us. So they say that in 2014, the company sold for $8,000, so that's the amount of cash they got, plant assets that cost $50,000 and were 80% depreciated. We also know that total depreciation for the year was $20,000. Okay, so if a plant asset that cost $50,000 was 80% depreciated, that would indicate that depreciation expense that had been taken was $40,000. And that would mean that the basis in the asset was $10,000. Okay, so now we know that an asset with a historical cost of $50,000 that was 80% depreciated had accumulated depreciation of $40,000. The net book value of the asset, therefore, was $10,000. We only sold it for $8,000, therefore we have a loss of $2,000. Our accumulated depreciation balance would be our beginning balance plus depreciation expense for the year minus any accumulated depreciation that was related to the sale or retirement of an asset, and that should give us our ending balance of depreciation. If we go back, our accumulated depreciation balance was $40,000. Okay. We know we had $20,000 of depreciation expense for the year that was given to us in the problem. We know we took away $40,000 worth of $40,000 worth of accumulated depreciation resulting from the sold asset. That gives us an ending balance of $20,000, which is exactly what the balance was that we needed it to be. So we've reconciled that. Okay, so if we look then at our operating section activities, we started with net income. That was reported at $46,000. We've also been able to reconcile that retained earnings balance, so we know that we're good on that account. Depreciation expense was also given, $20,000. We've also been able to reconcile our accumulated depreciation account, so we know that that is the correct number. Okay. Now, if we go back to the lines that we highlighted in yellow, other current assets. Other current assets increased $25,000. Okay. Think of other current assets as prepaids or supplies, right? How does that balance go up? That balance goes up when we buy supplies, right, that we're going to use over time. The offset to that would be cash. So if our other current asset account went up, that must mean we had more cash outflows. So, increase in other current assets, cash outflows of $25,000. Current liabilities went up by $18,000. Okay, if you think about a current liability, think about it in terms of accounts payable, right? I have two options when I pay for things. I can either pay cash or I can request to pay on account. If I request to pay on account, that creates a liability. So if I instead paid on account versus cash, that in theory means I have more cash. So current liabilities, the balance increased $18,000, which represents a cash inflow, increase in current liabilities. This should be a positive number, $18,000, not a negative number. I will correct this on the slides. The increase in current liabilities is correct. The line above it is correct. It's just there should not be any parentheses. Okay, so if we put everything together then, we started with our net income. We're going to add back our depreciation expense. We're going to subtract our increase in current assets because that's an outflow. We're going to add our increase in current liabilities. That's an inflow. Now, we talked about the loss from the sale of the asset, so that needs to get added back. We also had a loss from the sale of investments of $9,000. that needs to get added back. Let's talk about that item for a minute. So we look here, it says in 2014, the company sold for $34,000 available for sale investments carried at a cost of $43,000. So we sold them for $34,000. They had a carrying amount of $43,000. The differential there is $9,000. Therefore, in our financial statements, in our income statement, we recorded a $9,000 loss that caused our net income to go down by $9,000. That was a non-cash item, so we need to add it back. So our total then cash flows from operating activities are $70,000. Okay, so now we're ready to move on to net cash flows from investing and financing activities. We're going to follow a similar process. We're going to review our long-term asset accounts, our long-term liability accounts, and our equity accounts included on the balance sheet for the changes that are driven by cash. I find it easy to make T accounts and note whether balances have changed because of cash or non-cash activities. And it's also important to remember that regardless of whether or not you selected the direct method or the indirect method for your operating section, when it comes to investing and financing, they are completed the same way. This slide just shows you what some of the items are that you may see on the investing section component of the cash flow statement, and whether or not they would be considered cash inflows or cash outflows. Again, this is where I want to remind you that we don't talk about increases or decreases, we talk about inflows and outflows. Similarly, for the financing section, these are some of the items that you may see, along with whether or not they are an inflow or an outflow. Okay, so we already had briefly talked about the long-term assets. There was a decrease in the balance of $43,000. We said that was the sale of the securities. Remember that we are reporting cash proceeds, so the proceeds from the sale of the available for sale securities is going to look like an inflow of $34,000. For plant assets, there was an increase in the balance of $120,000. We know that that balance decreased by $50,000 from the sale of an asset. So that means we must have purchased assets in the amount of $170,000 to result in an overall increase of $120,000. Therefore, we're going to show purchase of plant assets, an outflow of $170,000. So we add all of those then together, and we can see what our cash flows from investing activities were. Okay, now if we move on to our financing activities, for bonds payable, there was an increase of $75,000, which we're going to say then is proceeds from the purchase of a bond. Common stock, there was no change in that balance, and retained earnings, we've already proven that that was the result of net income and dividends, so we're going to show the payment for dividends of $10,000 here. On problems that you're going to get, if there is no specific indication that a change in a balance is the result of non-cash activity, then you should just assume that it was cash activity. So for example, for bonds payable, there were no additional notes talking anything about bonds payable. Therefore, it would be appropriate to just assume then that the change in that balance is the result of cash activity. We add these together, and you will see the cash flow from financing activity section. Okay, so then our final step is to reconcile our beginning and our ending cash balance. I mentioned before, your beginning cash balance plus your changes in cash from each of your three subcategories should equal your ending cash balance. And if your equation does not work out, then that means you did something wrong. So here is my reconciliation. You'll notice that it works out appropriately. Okay, so now we're going to talk about some of the adjustments to net income more specifically. And my hope is that by going through some of these, it'll make a little bit more sense why we're making some of these adjustments. So we already talked a little bit about depreciation, and this is the most common adjustment. Amortization acts just like depreciation, except that it is usually limited life intangible assets and deferred costs such as bond issuance costs. So the main reason that we're making these types of adjustments is because the expenditure, which had the cash outlay, was made in a prior period, and that asset that was originally required would have been recorded as an investing outflow with no impact to net income at its acquisition. We know that in the current period or in several periods, we are amortizing or depreciating that asset, which is reducing net income, but there was no cash impact because that had already been recorded in a previous period, so we add it back to negate the impact to net income. Post-retirement benefit costs. So here we have to adjust net income by the difference between the cash paid and the expense recorded. So if pension expense recorded during the year is higher than the cash paid into the plan is underfunded, and if pension expense is less than cash paid into the plan is overfunded. So when we have the plan in an underfunded status, we need to add back that amount to net income in order to derive our cash flows from operating activities. If we are in an overfunded position, then we need to subtract that difference. So we'll talk a little bit more about pensions in week 6, but I just wanted to let you know this is also another type of adjustment that you may have to make. Okay, change in deferred income tax liability or asset accounts. So again, we haven't actually covered accounting for income taxes yet. That will be in week 5. But basically what I wanted to let you know is what really matters when it comes to the statement of cash flows is the cash actually paid for taxes. And the timing of when we pay taxes differs from when we may record tax expense on the income statement, and the differences between cash taxes paid and the provision for income taxes or income tax expense on the P&L flows through deferred income tax liability and asset accounts. So that's why when we are determining the amount of cash paid for taxes, we need to look at what happened to the balance sheet accounts for deferred income tax liability and asset accounts. Equity method of accounting. So we just covered this last week when we looked at investments. So if you remember, an investor debits the investment account and credits investment revenue for its share of the investee's net income and credits dividends received to the dividend account. Both of those net impacts are non-cash adjustments since investment revenue increases net income without a corresponding increase in cash. We must reduce our net income by the amount of the investment revenue received. However, if we got a dividend and we actually received cash, then that is considered a cash transaction. So that one does not need to be adjusted for. Okay, we add back losses to net income because it's a non-cash change on the income statement, while if it's a gain, we are going to subtract it. Proceeds, including the gain or loss component from the sale of long-lived assets, are recorded in the investing section, so to prevent double counting, we must adjust the gain or loss portion in the operating section. Unrealized gains and losses. So if an unrealized loss or gain impacts net income, which we know that happens with trading securities, we must adjust that. But if the loss or the gain impacts OCI, no adjustment is required because those changes flow through the statement of shareholders' equity. Now, with that said, though, it's important to take into consideration any of that change in OCI to make sure that you're able to reconcile your changes in your statement of shareholders' equity accounts. Stock options. Cash is not impacted when stock option expense is recognized, so therefore we must add back to net income the amount of stock compensation recorded. We already talked about income taxes paid. So treatment of non-cash transactions. So non-cash transactions are not included on the statement of cash flows because they are non-cash. However, they do require disclosure. And some examples that would require disclosure in your footnotes would be acquisitions of assets by assuming liabilities or by issuing equity securities, exchanges of non-monetary assets, refinancing of long-term debt with just new debt, conversion of debt or preferred stock into common stock, and issuing equity securities to retire debt. So here is an example of a significant non-cash transaction. So as you may recall, back in 2016, Marriott acquired Starwood Hotels, and they acquired Starwood in a combination cash and equity transaction. Each share of Starwood stock was exchanged for $21 of cash and 0.8 shares of Marriott stock. So, as a result, right, the $21 of cash per share would have showed up on the statement of cash flows, but the 0.8 shares of Marriott stock would not show up on the statement of cash flows because it was a non-cash transaction. And what you'll actually notice is in the description down here below, the fair value of Marriott common stock issued in exchange for Starwood outstanding shares was almost $9.2 billion. So this was a very large transaction, and therefore it was important that it be disclosed even though it wouldn't show up on the statement of cash flows. Okay, next I wanted to spend just a couple of minutes going over some common cash flow problem mistakes. So these are common mistakes that I've seen students do in the past, and so I just want to take a few minutes to cover them in hopes that you will not make a similar mistake. Okay, so the first is common stock and additional paid-in capital. So we learned 2 weeks ago that when it comes to issuing common stock, right, the common stock account gets credited for the number of shares of stock at par value, and any price paid above par value goes into additional paid-in capital. So what is important to remember is that you need to look at these two counts together, and they should be reported as a single line, not as separate lines. So if we look at an example here, we can see that capital stock increased by $5,000 and additional paid-in capital increased by $22,000. Okay. So assuming there were no non-cash components within this increase, what this should look like would be proceeds from the sale of common stock, an inflow of $27,000. Not proceeds from the sale of common stock, or you could say capital stock, $5,000, additional paid-in capital, $17,000. $22,000, right? It should be shown as one line, not two. The allowance for doubtful accounts can also sometimes trip students up. So if we look at this example here, our accounts receivable went up by $15,000, and our allowance for doubtful accounts went up by $6,000. So on a net accounts receivable basis, we have an increase of $9,000. Okay. So how should we appropriately account for this? Okay, so if we were doing the indirect method, we would say increase in accounts receivable, an outflow of $15,000. increase in allowance for doubtful accounts, an inflow of $6,000. Okay, now let's take a look at what that really means. So, an increase in the allowance means that there was a debit to bad debt expense and a credit to the allowance for doubtful accounts. That's how the allowance for doubtful accounts gets bigger. Since bad debt expense is a non-cash charge or a non-cash expense, it needs to be added back to net income. Now, alternatively, you could compress those two and just say increase in accounts receivable net, an outflow of $9,000. So either method is permissible for your homework assignments, your quizzes. So that's the appropriate treatment for the indirect method. Now let's take a look at the direct method. So in the direct method, it is not appropriate to net the allowance for doubtful accounts against accounts receivable. Here's why. So bad debt expense is a component of operating expenses, and therefore they need to remove from operating expenses because they are a non-cash item. So let's see. Let's assume that we have sales revenue of $100,000. Okay, and we have expenses for salaries, utilities, and bad debt. And our total operating expenses are $60,000. So that tells us that our net income is $40,000. Okay, so what that then means is if we go back to, this was on slide, just a second. Slide 14, which gave us the formulas for determining direct method cash flows from operating activities. So cash receipts from customers, we're going to take our sales revenue, $100,000, and the instructions said we're going to add a decrease in AR or subtract an increase in AR. So we had an increase in AR, so we're going to subtract that. So that means our cash receipts from customers are $100,000 minus 15, or $85,000. Okay, then for cash payments from operating expenses, okay, it was $60,000. Okay, we are not given any information about any changes in prepaids or accrued expenses. However, we know that a component of that operating expenses is bad debt, and we know that bad debt is a non-cash charge. So we need to subtract out that $6,000 to determine how much cash we paid for operating expenses. So that is 54. Okay. So that is the end of our cash flow section. I just want to point out there are some additional practice problems that are included in the appendix to these slides, and the solutions for those problems are posted in Leo under week 4, so you can go and take a look at those.